Hello, my name is Henry Lowe and I'm one of the partners in our private client team here at Mercer Hole. I'm here today with Michael Lapham, one of the directors in our financial planning team. And we're here today to discuss some of the exciting changes that have arisen from the recent budget, and in particular focusing today looking at things around pensions. So we've gone through and highlighted six key points and areas. So perhaps we can just discuss those in a little bit more detail, starting in the first instance with the lifetime allowance. How's that changed?
Well, in terms of lifetime allowance tax charges, they've been removed. So going forward, there isn't the limit that there has been in the past. Previously, the standard lifetime allowance was £1,073,100. So if you had pension savings in excess of that, you might be facing an additional tax charge via the lifetime allowance tax charge.
Now, in the past, you were able to take 25% of the lifetime allowance as a tax-free lump sum. Does that mean now that the sky's the limit in terms of your tax-free cash?
Unfortunately not, and that's where the standard lifetime allowance will still apply. Going forward, tax-free cash will be limited to 25% of that figure still.
Now, turning to the annual allowance, the amount you can put into your pension each year and receive tax relief, how's that changed?
So that's been increased. So for most individuals going forward, they'll see a 50% increase in their annual allowance. So the amount that they can actually put into a pension on an annual basis has increased from £40,000 to £60,000 a year.
So in the past, there were certain restrictions in place and a tapering of the annual allowance for higher earners. Has that changed in any way?
Well, the tapering still exists, but the minimum permitted contribution has increased from £4,000 to £10,000 a year. So a 150% increase in that number. The figure at which the tapering starts to be introduced has also increased from £240,000 to £260,000 a year. So again, more scope and flexibility around pension contributions.
So ultimately, it's good news for higher earners, and they're likely to be able to pay more into their pensions on an annual basis.
Absolutely, but not just higher earners. So another change has been to the maximum amount of contribution that those affected by the money purchase annual allowance can make. So those are individuals who've made withdrawals from pension arrangements, those being taxable withdrawals from a flexible pension. Their contribution limit going forward has also increased from £4,000 to £10,000. So generally speaking, there's more scope for higher pension contributions for most individuals.
Very good. Thank you very much, Michael. Generally speaking, pensions are outside of your estate when it comes to calculating your inheritance tax bill. For those who die before the age of 75, who have funds remaining in their defined contribution pension arrangements, they can pass this on effectively tax-free. We have for some time now been advising clients who have sufficient funds outside of their pension to cover their ongoing expenditure, to use that money first, and to preserve their pension as a pot of last resort. The recent changes have made the advantages of this approach even more pronounced. So if you're looking to mitigate the impact of your inheritance tax bill, one of the first things you should be considering is seeking to preserve your pension pot, and if you can afford to do so, potentially making further contributions. At Mercer Hole, our dedicated team of experts are committed to helping you and your families with your tax and financial affairs. Tax and financial planning, some things just go together.